Hi, this is Randy Finney with Right Side of the Chart, and today is Monday, October 9th, 2023. It's 12:12 p.m. Eastern Time. I'm starting the video, so midday update. Just wanted to mention on Friday, as I posted in the comments section, the audio was not recorded in the video. That is an occasional glitch that happens. It's very hard to catch. So for some reason, that screen recording software just randomly decides at times to toggle off the microphone recording option without any type of heads up. So you got to try to pay attention, as I usually do, to make sure it's on when I start the video. So as I had mentioned, well, in that one you couldn't hear it, but also in Thursday's video before that, last one I did, that I had to cut out to the Keys on Friday, leave town to go down to the Keys, and I was gone until last night. So anyway, I'm going to pick up where we left off this morning. I fired off a couple charts to you, and I'm going to go over that. So here's what we're going to do in relatively quick order. We're going to go over the broad markets, mainly the Nasdaq, but I also want to look at the euro US dollar. There's definitely something worth noting there, and the banks. Today, you know me, I've been henny penny lately with sky is falling or may fall, with a lot of red or yellow flags, really I call them. And again, I'm going to go over that. We didn't get the final breakdown yet that we need to see to open the door to more downside in the markets. I'm going to get to that in a second. That's at key level on QQQ. On the contrary, the bulls have been defending that for a couple weeks now, and that basically the bears haven't been able to take it down yet. In other words, I'm metaphorically speaking, the sellers. It's all about supply and demand dynamics. If you have more sellers than buyers on a security, including an index, it goes down. And if there's more buyers at any point in time, it's going to go up. It's that simple. All right, so we're going to go over the indexes, look at the euro, look at the banks. I just actually, right before it started the video, I decided to go ahead and started to take positions. So I have starter positions in three of the big banks. I'll go over those in a second. I'll do an update on crude oil and natural gas, and then we'll leave it there. I did see a request for updates on commodities, wheat, all that stuff. I'm going to just put that in a separate video. We'll look at commodities separately. Crude and natural gas, they're the big ones, so I'll lump them into this video. All right, let's start out with QQQ, or NQ, if you will, and then we'll go to QQQ. Nasdaq 100 futures, just kind of reiterate, Wednesday, you give you three targets with a max bounce target. We were down here of 15, we'll call it 15,250, right? It's a little hair below that, and I still think that's a possible target. Now, here's the thing. If we get there, and I'm gonna go over the micro levels, which I gave you this morning, we need to pop right here. You can see we really, that's not the tool I'm looking for. Right here, we have some pretty decent resistance. So if we can pop that, that should open the door for a move up there. And again, we'll get to that. And where I'm going with that, if that does happen, it has the potential to really help firm up the case for more upside. In other words, it's not much. We're talking from today. There were a couple levels on the chart I got out to you, and these are the same charts. The only thing I added was one little minor resistance level here this morning on the 60 and 15-minute charts, about 15,040. But we had a pullback to here. This is support. So the way this works is if we break out, then we're likely going up to the next stop. And I did have a line right there on the chart I gave you this morning. There's going to be minor resistance at that previous reaction high. And if we take out the support level below, that'll be bearish. So that level was there for a reason. You go all the way back to here. A lot of reactions about 14,933. And then, of course, then you have the downtrend line. Maybe you back test that, but if you undercut that, you really get to these lows. I think we'll just go on down through them, and then be especially bearish if we no longer have the positive, aka bullish divergence we did. So this was a divergent low, was and still is as of now. And again, that's the snare at us going up. But if the RSI and the PPO were to reverse, if we have a big reversal and they reverse, and then you take out these previous lows right here and here, you no longer have the positive divergence. And it's not the be all end all, but it for me it makes a very hard case to be bullish, or to be And the other thing to that too is, and I've said this often, positive divergences, divergent lows, and bullish chart patterns, falling wedges, whatever type you're looking at, they tend to work much better in an uptrend, obviously, in a bull market. So you get these 60-minute divergent lows, and that's my go-to or my favorite swing trading time frame. That is usually time to position long for the next double-digit, 10% plus move. Usually take you up to new highs after a correction, and so that needs to be noted there. However, in a bear market, if that's what this is, then that may not play out. And that would be, again, it would be a tell for me. Right now, I'm leaning towards these playing out a little more. And targets I gave you last week, nothing's changed. And even then, what I want to do the video on today, there's a potential this and other things I'm going to cover in this video, if they continue to firm up, then I may extend targets. I may be looking at more. We'll get to that in 1 second. So that was the 60-minute chart, and really we've gone nowhere since this morning. We popped that level. We came down here post-opening. Here's the, no, that's the 60. Here's the 15. I got this out to you this morning. So there's that 15,040, right? And we popped it once, shot back down. So really what happened today, if you were watching, immediately after the open, after I got that post out to you, which was just before the open, we shot down and hit that same level. I've had this level here since last week, at least 14,955 at support. So that gave you a buying opportunity there. We didn't break out yet. We came down, hit there, and bounced. We have now taken it out. We're above there. We're at 15,069. I had the support around 15,039. And so that should open the door, like I drew out to that, to those upside targets. About, little reaction here. I don't even know if that one's worth gaming. There's a gap right there. Gaps are very uncommon in the Nasdaq 100 futures or S&P 500 futures because they trade virtually around the clock. They only shut down for an hour every day around 5 to 6 p.m. Eastern, just for kind of reset the clock on them and all that. And other than that, the real shutdown period is from Friday at the end of the day, and then they open back up on Sunday evening. So that's why when you're looking at futures, and one reason I like is pretty continuous and slick. And then you'll get this gap obviously was induced a lot by what happened over the weekend, the attacks on Israel, and so just market jitters. To that, just if you want my opinion, horrible what's going on over there. Absolutely horrible, especially killing civilians, children, women. But the markets, for lack of a better word, are pretty callous to that kind of thing. I've done this long enough to see, if an attack is going to have a really affect the markets like 9/11 did, taking out the World Trade Center, stopping airlines, going from flying and all that. Yeah, that's different. But, there's been a lot of similar geopolitical events like this, and at the end of the day, investors turn their focus back to, is it going to affect Apple or Microsoft or Amazon or GE or whatever. And so as of now, who knows? We'll see. Let's just trade the technicals, trade the charts based on what they're telling us. And so there it is. So we popped this level now. We took out today's earlier high that should open the door. And I'm still long and strong looking for a move up to there, especially my active trading account, even in my other accounts. I know, we're not out here. Let me jump to the QQQ charts and I'll tell you or show you what I was talking about a minute ago. So let's go to the bigger picture, daily charts. Here's that level. If you recall, we've had multiple sell signals and reasons to be short all the way down here, but the two big levels. Over a month ago or more, I color-coded this to make it very simple. I put red lines, the levels that needed to go to increase the odds. First with this one, which we did. Our initial sell signal was here, and then we'd breakdowns there, and objective short entries on the rally back. But this was sell signal 1. That's the primary uptrend line off the late December lows in QQQ. Then we went down, and that was kind of my final straw where, then it's time to get more aggressively short, and that would increase the odds that my additional near-term swing targets would be hit. But unless that goes, and it hasn't gone, and again, it needs to go, very important if you're new to this or new to my analysis, you trade in a daily time frame, all that matters is how the candles close. So that little intraday break, if anything was bullish, you might say, oh, we broke it right there, Andy. again, if anything, that was bullish because you didn't close a daily chart or whatever time frame. You're trading a 5-minute chart. All that matters is the closing print of the 5-minute candle, not the intraday or intra-period move. In a daily chart, it's the intraday move. And so why is that? Well, if you get the breakdown like that, others see that reaction low right there, and then you get new short sellers that might jump the gun, jump in, and then they realize when QQQ closed right back above the support the support level that was bullish, and then they get squeezed out and they cover. So bottom line is this: here we are. We've been, what is that, over 2 weeks. The bears just cannot take it down. There're just not enough sellers. No, look, it could go tomorrow, and if it does, or later today, let's just say hypothetically. And if it does, then hey, things have changed. And so does my positioning. And it's going to increase the odds that we're going to go down here and hit these. But unless that happens, all I see right now is you got to give it to the bulls, despite everything that's going on lately and all the red or yellow flags. They're holding that level, and that's that. So, and again, on Friday, we had the near-term breakouts, broke above the downtrend lines. That's what I was covering in the video. If you watch it, highlight the breakouts. And that was the big green candle, which took us right back to the top, which is again, these are levels that were here well in advance, 365. It was the top of that gap there, and that's where we closed on Friday. So it's, again, there we are in this range. Now, if we pop that's going to be bullish, especially on this daily time frame, especially a solid green close above there. And then the resistance levels overhead. I have different boards. Maybe it brings these previous targets back into play. T3 up here. Really, you can look at it this way. That downtrend line is probably going to be a magnet if we can break out above 365 right here. And then if that happens, and I'm going to go over some things that could give us a little bit bigger rally. Remember, I have not been able to eliminate my alternative scenario yet, which calls for a new marginal and another divergent high before the big drop. So that's still on the table. The odds are still, last week, I knocked them down a little and we were down here. But Friday's action, and if we take this level out, that's going to, again, it's in real time, it's going to increase the odds of that happening. There's still a lot of overhead resistance, including but not limited to. One potential bounce target would be a back test of the trend line there. And you also have some resistance here, about 381. So again, I'm just pointing out the next potential targets should we break above here. But let me say this. I know I repeat myself a lot because these things bear repeating. Just like support is support until and unless broken, and it hasn't been, resistance is resistance until unless taken out. So there we are, guys. We're at resistance. We're kind of bouncing around. Simple stuff. If you recognize a trading range, as long as that range continues, the MO is buy, go long at the bottom, and sell and or go short at the top and play ping pong, until that ends. No range lasts forever, but that's been the MO so far. And look, we just hit the top and reverse. Here's a 60-minute chart. I did post that for you here. Let me pull up the website. Okay, here's this is the post I got out to you this morning. Well, you can see it. You already got it in your email. 360. What I gave you here is comparable resistance on QQQ for QQQ traders. Remember, I'll often follow up under posts if there's either questions that members post, or if I want to, hey, I should have included this. I do my best to on time-sensitive posts to get them out to you. And it's the fewer charts I have to mark up and annotate, the quicker that gets out to you. So the more charts I put in there, if I want to be all-inclusive, by the time you get it, it might be dated info. So this was QQQ, and so what I gave you is that 360, 671 is a comparable target to my 1520 on NQ, because I know a lot of you don't trade futures. NQ are the Nasdaq 100 futures. Now, how do I do that? How do I come across that? It's pretty simple, and I'm telling you this now so you can do the same. You can replicate whether I post a chart of QQQ and want to try to extrapolate those levels over to NQ or vice versa. Look at the reaction lows. See that? That was September, what was that? The 19th, I think, right there, something like that. That reaction low, the NQ chart I gave you earlier this morning, which is right here. No, it was the 60. Nope, yeah, that's the 60. Okay, so there's that 15,248.70. Again, I'll round it up to 15,250. There's the reaction low. If you follow my crosshairs down, that was September 19th, right? About 11, 12 o'clock, that reaction low. So then that's all you have to do. You say that's the reaction low. It was followed by that big drop. And that's where, you know, and it's not just that one reaction. I have some other reactions in there that help validate that support level, which I just circled. And so that's how I do that. And that's how you can do the same by, you know, just comparing the two charts and look for the turns and just double check the dates. Here, if I hold the crosshair again, it pops up in the left-hand corner, upper left corner, and it shows you September 19th at 12 p.m. Okay, so that's that. Today, the Qs have just been bouncing back and forth. You can see it here. I just toggled down to a 15-minute chart. You can see this was, for the last week or so, resistance, 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 resistance. And resistance, once broken, which it was on Friday, which, you know, that was a buy signal, this is simply a back test. So as long as that resistance holds, you think are two ways to trade. If you miss a breakout, if you didn't take it on Friday, then you were offered an objective chance to get into QQQ or out of your shorts if you were caught short, you know, on the pullback. And so that's, you know, that should take us up there, or right there, or wherever I had us. And now, if it goes the other way too, if we break that support, that's going to be bearish, especially the further you get back down in here. This is that week or so of consolidation we just had. So since we broke above it, this whole thing's a breakout. As long as that breakout sticks, that's near-term bullish. And if it doesn't, then guess what? It's a failed breakout, and that's pretty bearish. And then, you know, to me, as an active trader, close those longs and get back short. And I answered, you know, somebody asked about that in the comment section today. Hey, NQ broke out, but it came back, fell back below 1540. Thoughts? And so look, you know, we've already had, today's been whippy. We had a break, or actually now the second break above it. We'll see if this one sticks. So I'm not crazy that it failed, but NQ needs to hold, which I just showed you, that 14,933 support. So as long as that holds, and that's again the top of the trading range we broke out above on Friday. And but like I said, it can go the other way. So if 14,933, meaning support, is broken right there, that's not going to be good. So that's it. Okay, so that's it. That's NQ, QQQ. We looked at multiple time frames, simple stuff. I think, you know, I thought Friday's price action was bearish. I think the fact that they've defended this so far is bearish. That could change today, tomorrow. We take it out with conviction, especially if the divergences are taken out on the 60-minute charts and all that. Then that's going to change things. But let me show you one other thing, or a couple other things, and we'll wrap this video up. I'll get to the euro next. Okay, so the euro. Pardon me for this. I did this. I have these annotations on what I call a busy board. There's a lot of annotations here. The problem is if I turn them all off for a clean board, I kind of lose the what I wanted to show you. So I'm just going to drag over these. I'm going to use my arrow tool. Down below, on the bottom, is a PPO histogram. This is your PPO right here, price percentage oscillator. It's a very close cousin to the MACD. If your charting platform does not offer a PPO, which some don't, I just prefer it. It's just a little more, for several reasons I prefer it. But I'll use a MACD in lieu of it if I you know, some of the charting platforms that don't offer it. But what I look at is the PPO histogram on many, many securities, not just the euro, individual stocks, indexes. The PPO itself acts as a good trend indicator, just like the MACD. And that's why they call these down here, when the PPO line, here, let me zoom it up. The orange line right here is called your PPO line. The white line is called the signal line. It's just the 9 EMA of the price percent oscillator. And it's the slower of the two, the white line. So the PPO line, it responds faster to prices. And when you cross down below your signal line, like you did there, that's a bearish crossover. And that usually comes along with a trend change, especially when you have clean separation. Stay away from using these crossovers when the lines are flattening out. It's whippy. But it's a pretty good trend indicator. And then the histogram, if you put up a histogram, it's simply going to show you when the crosses occurred. So when you had that bearish crossover right here, which was clear, you went from green to red, and there's the zero line. So you cross down below the zero line, the histogram, right? Easy stuff, easy peasy. these red hills are bearish trends. The green hills are bullish trends. And so when it inflects, and again, you can see it here. You can see it's not hard to see when the lines start to roll over, when PPO's been going up, momentum's been going up because prices were going up. But then even when prices continue or hold up and the PPO reverses and starts going down, it just simply shows you momentum is waning. That bullish momentum is waning. Likewise, when on the downside too, when you're in a downtrend, you start to PPO, the momentum indicators, the PPO and the RSI start to turn up, especially if you can coincide with a oversold reading on the RSI like you did here, here, and here. So again, I use these never standalone. I use them in conjunction with other things. But let's just keep it simple and focus on the PPO bullish and bearish crossovers. I did a couple weeks ago highlight one there. You can see, again, visually, you can see when the lines are turning up. You can also see when the histogram is moving up. And you don't have to be an expert to predict. Now, there's nothing 100%. Sometimes they look like they're going to cross and it gets rejected. But again, you don't have to be an expert in technical analysis to look at this slope coming up and anticipate a likely crossover, right? Likewise, when the momentum is waning, these green hills start going, the bars start going down, and then you ultimately get the crossover. And if you went, if you just traded this alone, you'd outperform most traders going long and short the euro. You should go short when you cross from green to red, when you get the crossovers. And likewise when you go from red to green. And so I wanted to point that out, that we've been in a downtrend, a pretty strong downtrend for a while. You've got I have a pair of parallel downtrend lines in the euro. We're coming off oversold readings. The last time we were oversold on the RSI was right here, and the euro gave us that. The time before was here, and it gave us that. If you're new to the site and you're saying, Randy, why are you talking about the euro US dollar? I don't want to trade currencies. I want to trade the Nasdaq or the S&P or gold, silver. They are highly, highly correlated. I've gone over that. Do it yourself. Take a chart of USD, Euro USD, put it over the S&P 500, Nasdaq 100 since, for the last 2 years at least, and you'll see a very, very strong positive correlation. So if you can anticipate where one's going, the euro or the dollar. Remember, it's just dollar is just inverse to the stock market. That's why I'm using the euro dollar pair. It's just showing you really the dollar upside down because the euro is the biggest component. And so I wanted to point that out, that we have now a clear crossover, 3 days of the histogram increasing right there. So these were whipsaws, but you could see the crossover seemed imminent. We were pushing up against there, and now we have crossed over. And again, last bullish crossover was right here. You got that rally in the euro here. You got that rally in the euro here. You got that rally in the euro. And again, all right, we'll just do this way. If you don't believe me about the euro US dollar, we're going to go here. We're just going to compare the, we'll do the Nasdaq QQQ to FXE. And so this is, I'm going back here for the last few months. Here, I got to change this. They're starting at the same point. I don't want that. There we go. Okay, FXE is the Euro ETN, right? It's the same thing we were looking at, just trading on the same trading hours here as QQQ. And now you can see the clear correlation. They're not going to move in at the same price point because the indexes move up and down much more in percentage points. Just look at when they turn. Look at the peak right there in the euro, which was a trough in the dollar, right at bottom in the dollar, and that's right when QQQ bottomed, and they both corrected. And then they both bottomed here, and they both went up. And then we had the correction here in the euro. There was a little bit of a disconnect, but right there, QQQ got the memo. They both went down, and the correlation returned. So it is not a perfect correlation, but it is an almost perfect correlation. They both peaked right there. The euro's been falling since. The Nasdaq has been falling since. So if if this buy signal we just got in the euro sticks and the trend changes and we get, even if it's just a relatively brief counter trend bounce, then most likely, not guaranteed, but most likely the market will bounce too. Again, it's where the inflection points are in the overall trend. All right. And you can look at that. I didn't even mean to do it with QQQ, but I still had the histogram up. I was just about to close that window out. Bullish cross there. Let's just play that game for a second. Let's turn off all the lines here, squish this down, And let's just follow this up. So last bullish crossover was right here, and we got that rally. We just made a bullish crossover here. Maybe we rally. We had one there. It didn't last very long, but as long as it lasted, we did get a rally. And then it said, if you're following that signal as a purist, it said, all right, get back short again. And you would have got all of that if you stayed short throughout the red. You would have got all of this if you stayed short here. Green right there, you had a buy signal. It went from red and we were correcting. And then it said buy right here, and you caught all of that if you followed just that one signal. And again, I use this in conjunction with other things, but you can see here, Green Hill right here, right? Rally. Okay, and then of course leading into that, we were in correction mode. So it's pretty good stuff. And you know, and again, sometimes there's whipsaws or there are crossovers, and they're good for a brief rally, especially in a downtrend. That's the thing. You got to keep in mind that if this is just the start of a much bigger drop, and the market is going a lot lower, like I believe it is, but if it's going a lot lower now and not later after a bounce, then this may be a fleeting buy signal, or may even be proved to be a whipsaw. Even though, again, go back here for last year or so, it's beginning of 2023. These are pretty clean hills, I call them. These red are inverted hills. This green's a positive hill. And, you know, that wasn't even really a whipsaw. It would have, you know, it didn't last long, but it was a buy signal for a few days. So, all right, guys, that's that. So, hence, I'm sitting here and kind of telling you why at the moment I'm long, and, you know, may continue to stay long if some of these things firm up. So, there's the euro again. Something that I do, and I don't know how many other traders do, to confirm or refute any of my analysis that I have on gold, silver, which also move positive to it as well. All right, I wanted to show you the banks, then I'll get to crude oil, natural gas, and I think that'll be it. I already gave you enough on gold and silver last week. I can't do it all in this video, or it goes for hours. USO, crude oil. Obviously, you know, I told you last week I was long crude, and showed you a couple of weeks ago we were short. I gave you a short setup back here after, you know, Virgin High. We shorted it there, T2. Never made it to our third target, but we reversed off T2. Then we put in this bearish rising wedge. We had a sell signal right here. We started to go down. I said we'd have to take out S1 for support level, which was down here to get there. But then we popped, and in advance I identified that trend line. Said if we pop that trend line, we're probably going to go up and pop and make a marginal new divergent high and a marginal new high, and then reverse. And that's what happens. We did that because, as I said at the time right there, if we did go up and make a new high, it would still be a divergent high, and therefore that would most likely mark the top, and it did. And then from there, as we know, crude fell down 12% right to that potential third and final target I had, and that's where we bounced, reversed, and then bounced on Friday. And of course, the attack on Israel certainly helped pop crude, and right back into T1. Remember, T1 was the first target of the downside, because support, once broken, then becomes resistance. So that was on the upside, a place where I took profits today, because that was a former resistance level. I'll probably get back in. I think we can work our way up here. There's a big old gap to be filled on USO. Right now I'm just kind of sitting back. And I'll most likely re-enter where? Well, today's gap up. I'll take a look at the futures. I trade CL, but we'll look at those as well. And you can see there's a couple gaps in that area. So if we pull back, that's probably going to be it. And then we'll pop this trend line, this downtrend line right here, and run up, especially if things continue to heat up or get any worse over there in the Middle East. So that's crude oil, USO. And somebody asked about natural gas. Again, you're going to get updates throughout the day if you come in under the recent post. Somebody said, yeah. What did you say about UNG in the last video? And the audio didn't work on Friday. And here it was. UNG, well, let me just pop the chart open. UNG made an impulsive breakout. So remember this trading range I've been talking about. We put in, you know, the longer term bullish case is a fact. We put in a divergent low back here, all the way back in June, in which case I gave you four price targets, T1, T2, T3, T4. We hit T1 there, pulled back. We even popped above, hit T2. But for the most part, as I've covered, we've been in this trading range right here for months now, most of the year. And then, so this was significant on Friday here. Let me go to the live chart and you can see it a little better. UNG, natural gas ETN. This is a 60-minute chart. You can see, I think I just showed, yeah, that was a daily there, but you can see it clear on the 60-minute too. 738, I think that might have been the one I took. 738, lots of reactions, even though it's a somewhat sloppy range. If you know, what I see with my eye when I look at it, I see most of the reactions right there, and I see a few pops that didn't stick. And remember, this one was the one that hit T2 before. It was a price target. The reason I list multiple price targets is each target, you know, in advance. Now, when we get there, things may change, but usually when I look at a chart, and this was laid out, those targets were laid out months ago, it's the initial tag of each target you're likely to get a reaction. Once it's been tagged, you can get multiple reactions, but the odds are, since you already had that reaction, in other words, we already hit T2 almost perfectly and reversed, so now it wouldn't surprise me if we go right through there. It hasn't been hit in a while, so they may step in, and you know, and if they do, then you can now a pullback, because 738 was the breakout point on Friday, and so that increased the odds as we made an impulsive breakout on Friday above 738, the top of this range here. It increased the odds we'll go and hit T2, which is the next resistance level, was and still is. It's already been hit once, and that helped to validate it. Remember, when I laid it out back here, when I created that target, it was back in March of this year originally, and I might have dragged it and moved it, but that was the same target. And so it was a target there because I noticed it as resistance here, and a likely, just based on the pattern and everything, a likely target to be hit. But the fact that we did hit it in August helps to further validate that as a significant resistance level. Now let me say this too. I wouldn't put too much into it, because although UNG is non-leveraged, it is an ETN that is attempting to, and what they do is they use futures to track the price of natural gas. It's basically, it's buying futures contracts. I trade the futures directly. It's more of a pure play, so I'll have to look at that chart. Over time, due to slippage and fees that they have rolling the futures, it's not going to track natural gas prices as perfectly. So this level may or may not be, may need to be adjusted. But either way, kind of what I'm getting at, it's been a multi-month basing pattern. We broke out. So natural gas, like I've always said, when it wants to run, it can really run. It can make overbought just look more over and overbought. So bottom line, it's near-term bullish now since we broke that level. And if we can take out T2, that's going to, as I said in the post here, it's going to increase the odds that these additional targets, T3 and T4, are going to be hit. And if I need to modify them, I will. So that's, again, you can catch up on that in the trading room. I'm sorry, in the homepage there, under the comments section. Now to the banks. Okay, so we're not out of the woods with the market yet. QQQ, I'm going back there. We've just been bouncing around today. You know, a lot of very volatile, but let me show you something. So recently, one of the potential yellow flags I've been watching are the banks, the regionals and the big banks. And for the first time in a while, you know, the king of all, JP Morgan, you know, had a lot of reasons to be short. Starting back here, blow off top right there, divergent high, and it's been stair stepping lower. Then we had the breakdown above the primary trend line off the October lows. We back tested in a little bear flagging type action. We broke down, and we've been moving lower. However, when you turn off all the lines, or let's just leave them here for now, you can see there's a lot of support. I have more of a support zone in this area here, because this was our previous highs right here, right? Here, then we finally made a breakout right there. Let me change up colors here. That was a breakout above this very, very well-defined resistance. And as usually is the case, you rallied hard and you came in and back tested, bounced. They bought the back test, bounced. They undercut it slightly, just like QQQ recently, right? Slightly dipping below my red line, but it recovered back. But as I mentioned, you know, in addition to price support, both on the Nasdaq 100, the S&P 500, a lot of these key stocks and sectors, in addition to good price support, you also have the key 200-day moving averages. And as I've said repeatedly, usually, especially when you got way above the 200s, they're going to buy the first pullback on key sectors and key stocks to their 200-day moving averages. And so in the case of JP Morgan, you have both the 200 simple and exponential, and that's exactly where we hit the other day, this candle. And we're still holding above support, just like the Nasdaq 100. So not only that, you have positive, nice, clean, positive divergence. That's the indicators making higher lows versus their previous lows against prices making lower lows. So you have a pullback, a healthy pullback to the 200 days, and there's a potential here. Here's a nice, clean downtrend line on JP Morgan, and that forms a bullish falling wedge. So if the banks can reverse, and the big Canadian banks I highlighted recently that were making multi-year lows and still are, they're right off right now, they also have positive divergence. So I know looks like the sky's falling right now, and it may fall, guys. It may fall, and I'll be back short like that. I will get out of the longs, but as of now, what I did today, I figured I'd take some starter positions. It's a catch a falling knife trade. A catch a falling knife trade because I bought the big three American banks. Bank America just fell to a multi-year low. So you had, this was our March low, the March low on Bank America. It took that out recently, big red candle, and it's still trading below it. So by every metric, 99 out of 100 traders look at this, say that's a very bearish chart. You want to short Bank America, and maybe they're right. On face value, you do. You short a break of new lows, because when a stock hits a new low, the reason that's bearish is every single holder at that on the day it makes a new low is underwater. There's not one profitable, trader that's been in the stock for, other than that day. And so therefore you have people just wanting to get out. They've been feeling pain all along. And so typically it drops. That's the same exact logic in reverse why a new high, a stock breaking out to a new all-time high, or even a 52 or multi-year high is bullish, because everybody holding the stock at that point in time is profitable. So nobody's looking to get out. The first pop we have, I'm going to sell into it just to get out. No, but as I often say, fewer things are more bearish than a breakout to new high that fails, and then likewise a breakout to new lows that fails. So if we do this, you're going to have a lot of traders that they didn't want to short Bank America up here at the divergent high because it was ripping and the banks are strong and blah, blah, blah. That's when I like to short, when I see a divergent high and everyone else wants to buy it. And so the way I look at this, I'll keep it simple. The banks may just collapse. Fundamentally, I can sit here for an hour and tell you all the reasons. You can read about them. All the commercial properties sitting vacant right now, vacancy rates on office buildings and other commercial REITs and things they hold, both the regionals and the big banks. You've got all the hot money in the banks with the 5.5% CDs and money markets, all these promo rates. That's called hot money. People are going to move to another bank because they're offering a teaser rate of 5.5 on a CD, put their money there for 6 months. When that CD's up, they're going to pull it out of Bank America and go to Wells Fargo or a local community bank, whoever's offering the next rate at the time. And that's just not a good, sustained business model. So I can sit here all day long and tell you fundamental reasons why I should be shorting the banks. And I may flip around if this doesn't pan out. However, even though since it's a catch a falling knife trade, I don't care who you are and what your views are, you cannot argue that Bank America is not solidly entrenched in a downtrend. It just made a new multi-year low. So your opinion on where it's going is one thing. The fact is it's in a downtrend. So that is an extremely aggressive counter-trend trade. But the way I look at that, so maybe it does, and I will say it has a higher rate of failing going long like I did today. I'll give it a little room on the stops, maybe a punch out, wash out move, but not much. I'll keep my stops relatively tight. And so even though it has a lower probability of success, the RR, the risk reward ratio, if they can reverse and the Nasdaq breaks out and the S&P breaks out above resistance, we get a little rally and the charts start to firm up and the euro continues to rally, well then guess what? These banks are all going to snap back above those lows, and you could see a powerful short covering rally. And that's why I take the starter positions. No buy signals yet, but I want to be in it in case that happens, and then I'll add to those positions. So at this point, I'm only going to add. I will not add on weakness. I will only add on strength above there. If you see on Bank America, you've got a little period of consolidation right here over the last few days, and it needs to pop that and get going there. Where to? I would say at least that downtrend line right there and the 200-day moving averages are way up here. So I'm looking at making roughly, let's say right here, about 22.37 in the downtrend line. That's about 14%, and I'll give myself, 3% on the stop. So I'm looking at a 7-to-1 RR. So again, the trade may not pan out. If it doesn't, I lose 3%, but if it does, I make 14 right now, according to that target. And then that Citigroup also, same thing. Citigroup just punched through. There's your previous low, October lows when the stock market bottomed. Citigroup punched through there last week, and it did so with positive divergences, bullish. And Citigroup also reversed and has recovered, not by much. I have that low right at about $40 even. You can see there. We're trading at 40.24. So again, that's the only reason they're starter positions for me. But, obviously if I didn't think it wasn't going to happen, then I wouldn't do it. I would just wait for a little more downside, wait for these divergences to fall apart and short. And you could do it too if you think the banks are going to collapse, short it and just put a stop a little bit above, above this downtrend line. That's an objective level, because just like the other ones I showed you, JP Morgan, Bank of America, you have these bullish falling wedge patterns. So anywho, that's a trade idea for you. Take it, don't take it. If it's, it is an aggressive counter trend trade, but like I said, manage your stops. Worst case scenario, if you wake up and there's something that really rattles, some big bank failure, or something goes wrong in the financial system, you could these things could gap down below a 2-3% stop loss order. So keep that in mind. And again, keep that in mind with your position sizing. Never should you put all your eggs in one basket, any one sector, any one stock. So to me, this is, like I said, it's a starter position, but one that I think has like I said, if not the best chance of playing out, a very good RR. And if it does, and we get a rally in the banks, by the way, the banks start to rally, you can almost be assured the S&P 500 is going to rally. Because if the banks are rallying, that's going to be assume that, hey, economic outlook, at least for the foreseeable future, is starting to shift to more bullish, more positive. So you'll probably see the S&P and, of course, the tech stocks rally too. So that's it. I like the banks, their trade ideas. Like Nasdaq 100. I gave you levels at the pop. And again, if this all starts to play out, then that's going to start to, abate some of those yellow flags that I've been watching. But I'll continue to watch each and every one, because it could be, guess what? The bank stocks may start to rally, and I may see, California muni bonds continue to tank against the rest of the municipal bond market, which tells me there's something wrong there. Or any other many things I'm watching, bank broker dealers and treasury bonds and crude oil, this whole Middle East thing and Iran being involved in this, and that nothing like 100+ barrel crude to put the brakes on economic growth. So, all right, guys, I'm throwing a lot out, but those are, this is really the same core stuff I've been talking about watching: natural gas, crude, for the inflation trade, treasury bond yields, the banks, and tech stocks, and that's it. So let me see. I think that's all I wanted to cover. Let me just pause this and review my notes. Yeah, that's it. And let's, of course, I didn't go over it now, but the FANGs. Remember, I pointed out Apple, the big dog in the Nasdaq and the S&P 500. Nasdaq, S&P 500, biggest component, fell right to the 200-day exponential moving average and right to that key, support level I have there at 166.61. Did so with positive, aka bullish divergences, so divergent low. And the only thing I might do now, like I'm seeing so many things, downtrends off the highs, downtrend lines. And those are all, of course, potential targets, as are these horizontal resistance levels. I'm going to move this one right now, change that to about 180. That's next resistance. Then the downtrend line. So divergent low, and it's been nothing but green sticks. We have one red stick since that divergent low recently. So again, this is what I've been watching. Downtrend line was taken out in Microsoft. Positive divergence on the RSI. PPO moving up. Alphabet still above this minor trend line. even though it broke down here, we had that sell signal, but it's been moving up and it's above this minor trend line until and unless that goes. And then the purple level, again, that's all the fangs. I had those purple lines, guys, that need to get taken out to really increase the bearish case, and most of them haven't. There's Amazon still above 123 plus the 200-day moving average, etc., etc., etc. All right, I'm going to wrap it up here, get the video out to you, and as always, I'll continue to hunt for new trade ideas. I'll try to get some updates on some of the other commodities out there. Coffee still looking like it has potential to rally. Wheat, corn, those guys, I think longer term, the setup is still there. They may, we may get a rally, but I'll cover those in another update. This has been Randy Finney with Right Side of the Chart. Have a great day.